Welcome to the Consumer Financial Protection Bureau's field hearing in Salt Lake City, Utah at the University of Utah. At today's field hearing, you will hear from Director Richard Cordray and a panel of distinguished experts who will discuss issues related to consumer access to digital financial records. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. As part of the Bureau's mission to protect consumers, to date we have handled over 1 million consumer complaints and provided nearly $12 billion in relief to more than 27 million consumers. My name is Zixta Martinez. I'm the Associate Director for the External Affairs Division at the CFPB. Our audience today includes consumer advocates, members of industry, credit unions, community banks, state and local officials, and of course, consumers. We're grateful to have the Honorable G. Edward Ed Leary, Commissioner of Utah's Department of Financial Institutions, here with us today. Let me spend just a few minutes telling you about what you can expect at today's field hearing. First, you'll hear from Utah Commissioner Ed Leary, then from CFPB's Director, Richard Cordray, who will provide remarks about consumer access to digital financial records. Following the Director's remarks, David Silverman, the Bureau's Acting Deputy Director and Associate Director for the Bureau's Research, Markets, and Regulations Division, will frame a discussion with a distinguished panel of experts. After the discussion, there will be an opportunity to hear from members of the public. If you'd like to provide testimony, please sign up in the front lobby. There's plenty of opportunity and time to do so. Today's field hearing is being live streamed at consumerfinance.gov, and you can follow CFPB on Facebook and Twitter. So let's get started. G. Edward Leary was appointed Commissioner of the Utah Department of Financial Institutions in June 1992. He joined the department in 1997 as an examiner and rose through the ranks, holding positions as industry supervisor and chief examiner before his appointment as commissioner. Commissioner Leary is a strong advocate of the state banking system and preserving the innovation and flexibility of state-chartered financial institutions. He has worked for the preservation of states' authority to charter and regulate financial institutions and financial services corporations. Commissioner Leary, you have the floor.
Good morning and welcome to Salt Lake City. It's a pleasure for me to greet you here on a couple of levels, and I thought it'd be an interesting place to start. Here, you have chosen to hold your hearing on the campus of the University of Utah. I might mention my alma mater. And also, you have chosen to hold it here at the former Fort Douglas that was an active reserve center for decades. I chose, besides my bank regulating career, to be a Naval Reserve officer coming out of the University of Utah. And after my period of active duty, I then drilled more than 20 years just down the street at the Naval Reserve Training Center. And this was my officers' club. So talk about coming home. It doesn't look anything like it did then. Going back in history, while it's fun for some of us who have been around, it's also very interesting when we get to hear what we're going to talk about today. Consumer access to and ability to specify or convey where their financial information goes from their financial institution. I've been involved with regulating financial institutions for 40 years. I keep thinking we wouldn't have been talking about this topic maybe even 5 years ago, maybe 10 years ago. So it's relative certainty, relative newness of this subject. I always think it's fascinating. there will always be new products, new services, new issues resulting from the rollout of those products and services. So for me, it's a hearing I look forward to hearing from the director, and appreciate you coming to Salt Lake City. So Director Cordray, thank you.
Thank you, Commissioner Leary, for the warm welcome to Utah. We really appreciate it. I'm now pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, he led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray?
Thank you, Zixta. We are very glad to be here, and for myself, it is in fact my first visit to Utah other than going through the Salt Lake City Airport, which I've done more times than I could count. And I want to particularly thank the Commissioner for his words, and we're going to have a chance to spend a little time later this afternoon, which I'm very much looking forward to. So thank you all for joining us today. We have a special moment right now to peer into the future and see what we can learn. And we have a great opportunity to begin to discuss how we can help shape the future in ways that support and protect consumers. We're here today to talk about the new opportunities and challenges being created through digital financial records. Whenever consumers make deposits, withdraw funds, or make payments using their various financial accounts, they leave a digital trail that becomes part of their financial record. This data yields enormous insight that can empower consumers to make decisions and improve their financial lives. The digital aspect of these records can enable great efficiencies. Whereas once upon a time, consumers might have brought a shoebox full of paper to a financial advisor or loan officer, maybe some of us still do that today, now consumers can accomplish the same thing just by providing access to their digital financial records. This is a world full of new promise, where consumers have the chance to gain the tremendous benefits of ease, speed, convenience, and transparency. And these are things many consumers value enormously. Where consumers can exert control by giving their permission for specific companies to access their digital financial records, they can access a growing number of services from a wide range of providers. Established financial institutions and startup fintech companies are pushing forward aggressively to create websites and mobile applications that offer consumers a variety of innovative services. Some sites help consumers monitor relationships with multiple financial institutions in one place. Others help consumers make spending decisions and manage their money while they're on the go. By looking at a consumer's transactional history across their credit cards, bank statements, prepaid cards, and any other sources of spending, websites or mobile apps can offer trend analysis that helps consumers understand their own spending habits. Some people may not realize how much they're spending each day or in certain categories of items, and these services can help them cut back and start saving for larger goals, or redirect their spending as they wish, with the consumer controlling their financial life. Similarly, access to digital financial records can help consumers become better shoppers and make markets more competitive. Many consumer financial products, such as credit cards and prepaid cards, charge fees for different uses, which means the cost of the product can vary based on what people actually do with it. Consumers are often not very good at predicting their usage or even understanding their usage after the fact. But if consumers are able to access their digital financial records, then new applications can help them identify the provider whose product best serves their needs. Access to digital financial records can be especially important to consumers who want to borrow money but lack enough credit history to generate a credit score, or whose score may not accurately reflect their current creditworthiness. By allowing a prospective creditor to access the consumer's transaction account, the creditor may be able to extend the credit needed at a fair price. These are just a few examples of services that already exist, and the future possibilities are vast. The existence of these products and services often depends on whether consumers can authorize access to their digital financial records. Companies that collect this information from other providers are often called data aggregators or account aggregators. Many of us have little or no idea how this actually works. If you pay your taxes online through a commercial website, for example, you may be giving a third party access to your financial records. Or you may pass on access to your investment accounts, so a commercial tax website can pull information about your retirement contributions for the year. This saves you time and effort because you no longer have to input all the information manually on your tax forms, and we all appreciate that. Access to digital financial records is critical. As with your student records or medical records, your financial records tell an important story about you. With healthcare, for example, if you're able to see your records, it's easier to participate in your care and treatment. You can review what you were told, ask tough questions, and consider other options. You can be a better advocate for yourself. The same can be said for your financial records. This is all about taking control and becoming a more active participant in your own financial life. As we see the world changing all around us at a rapid pace, Congress has recognized the growing need for consumers to be able to obtain and use their digital account information. Congress provided for the right to do so in the Dodd-Frank Act, which states that information relating to a consumer's transactions, including specifically costs, charges, and usage data, shall be made available in an electronic form usable by consumers upon request. Rulemaking authority over this issue lies with the Consumer Financial Protection Bureau, which also has the responsibility to pursue the statutory objective of ensuring that consumer financial markets operate transparently and efficiently to facilitate access and innovation. The technology around digital financial records continues to develop, and so far there are many unanswered questions about how the information is being shared, by and to whom, and how safely. As with any emerging industry, we're hearing about some bumps in the road. Both fintech companies and financial institutions, as well as consumers and consumer groups, are describing to us the various challenges, risks, and technological obstacles to further progress in this area. So today we're launching an inquiry to learn more about consumers' access and use of their digital financial records. Specifically, the Consumer Bureau wants to know more about three things. First, we want to be aware of what is happening right now, especially the extent to which consumers who are authorizing access to their financial records can choose how their records are being shared. Second, we want more insight into the process for sharing financial records, whether it is or can be made safe, and what assurance consumers and providers will have that it can be done securely. Third, we want to learn about transparency and how much control consumers have over their own financial records. Our main goals are to encourage innovation that promotes opportunity and to protect consumers as these new and promising technologies continue to develop. To begin with, the Bureau wants to know to what extent consumers can authorize data aggregators to access their digital financial records on their behalf and to share those records in accord with the consumer's instructions. Consumers are usually able to see their transaction histories when they receive their monthly account statements or log into their accounts online. The Bureau believes that both consumers and their authorized third parties should be able to access their records in digital format and to make sure the records can be passed on to new providers of products or services of their choosing. Once again, we can see this as the modern equivalent of consumers who used to bring in their cardboard shoebox full of information and offer it to any provider they wished. Yet we've been hearing a range of concerns about consumers' ability to access and share their account information electronically. We're concerned that some financial institutions have threatened to cut off the flow of information to some websites and mobile applications. We also hear of financial institutions that make consumers jump through so many hoops to access or authorize access to their own financial records that they're discouraged from even trying. If financial institutions that house digital financial records make it difficult or impossible for consumers to authorize access or share their information, that blocks opportunities for consumers to benefit from this information. The result could be to thwart new entrants from entering the market with consumer-friendly products or services, even those not being currently offered by the financial institutions themselves. For example, perhaps a consumer's bank does not alert its customers about how much of their existing balance they can safely spend, given anticipated bills that are known to come due over the month. If they're able to share their financial records more easily, another company may devise a way to help them monitor their spending and send them an alert when they get close to the amount they need to cover their upcoming bills. But that service will not be available if the company cannot access the consumer's records. Impeding access to digital financial records not only blocks innovation from new entrants, it also reduces the incentives for financial institutions themselves to innovate. Without new companies introducing consumer-friendly products or services into the market, established companies are likely to feel less pressure to compete in this manner. And authorizing access to their financial records can make it easier for consumers to shop for an alternative provider with more favorable pricing, given the consumer's usage patterns. To be clear, it is unacceptable for financial institutions to block access to consumer information as a means of gaining a competitive advantage in the marketplace. Of course, many companies use customer information to help retain their existing customers and serve them more effectively. In fact, we want markets where companies are finding ways to use the unique information they have about their customers to identify new needs or to offer more opportunities to improve the financial welfare of their customers. But these natural benefits of incumbency are very different from special advantages that stem from restricting the flow of information to competitors. No company should be able to hoard customer information as a way to deprive consumers themselves of the benefits of fair market competition. We've heard that banks, credit unions, and others that house this information have operational concerns about when and how they're supposed to share the information with third-party providers. These are legitimate concerns, and we want to learn more about this. Does the sharing of financial records impose burdens on staff time or other resources? Are there other legitimate concerns that the number and frequency of these requests could overwhelm the servers at financial institutions? We want to understand how the market is functioning right now. In today's request for information, the Consumer Bureau is seeking to learn about the incentives that would facilitate or discourage people from accessing and using their own digital financial records. We're requesting more information about competition between established financial institutions and prospective entrants to offer new financial products and services. We want to know what obstacles, technological and otherwise, must be addressed to facilitate access and use of digital financial records. And we seek to know more about technological developments that are changing how consumer records are accessed and shared, as through the automated program interfaces, or APIs, that some financial institutions, a growing number of financial institutions, are starting to make publicly available. Our second area of concern is that access and use must be safe. Customers should be able to have confidence that their financial records are secure and that they will not fall into the wrong hands. Financial institutions that share information likewise should be confident that they will not be exposed to unauthorized or fraudulent transactions resulting from efforts made to access customer information. It would be problematic for everyone involved if granting access to third parties were to compromise consumer privacy or put consumers' funds and account relationships at risk. Some financial institutions have suggested that providing third-party access to account information can create significant operational risk to them and could undermine account security. There may also be complexities around privacy protection and the assumption of liability for breaches that can occur whenever data is being shared. It is also worth noting that not all third-party service providers that use consumers' financial records are created equally. Some companies have more robust safeguards to protect consumer information than others. These differences may create difficult challenges for financial institutions. Scammers and fraudsters who try to gain improper access to consumer information pose problems here too, as they do in virtually every market. Our inquiry today seeks more information about how financial records are obtained, stored, and used by third parties. We want to hear from all relevant stakeholders, including consumers, financial institutions, information users, data aggregators, and technology providers, about options to ensure that consumers can safely access, use, and share their digital financial records. One thing we know for sure is that the technologies are developing rapidly, and it seems likely that workable solutions will emerge, if they do not already exist, to enable information transfers to occur smoothly and safely. Through our inquiry, we're aiming to understand this process better and to prod it along as we can. Third, the Bureau wants to make sure that the access and use of financial records is transparent and that consumers can direct the sharing and use of their own personal financial data. It is not enough simply to have safe access to financial records. Consumers also need to be able to control how each company that accesses their records will use that information to improve their lives. Specifically, if consumers give third parties access to their accounts, they should be able to dictate exactly what that access means. They should be able to say what information will be shared, how often access can be had, and how long that access will last. When consumers want to end their relationship with a company, they should be able to do so on their own terms. So in today's inquiry, we want to know to what extent consumers can control how data is used by companies who are authorized to access it. This includes the ability to request that these companies delete their records, or if the records are automatically deleted, when and how that happens. As we address these issues today, the Consumer Bureau wants to understand better just what is happening here and now, but make no mistake that our sights are set firmly on the future. We're not content to sit passively by as mere spectators, watching these technologies develop. We intend to keep an eye out to protect consumers, even as we encourage providers to innovate and open up more opportunities that benefit consumers. And although the natural reaction for many financial institutions may be to bolster fortresses around customer information, significant business opportunities may emerge from helping consumers by sharing information more readily with new financial innovators. In the end, we're looking for a marketplace that is fair and works well for all participants: consumers, fintech, big banks, community banks, and credit unions alike. We believe we must get to a place where consumers are able to access and share their financial records with trusted third parties without undue restrictions. We're confident that financial institutions and other companies can develop technological solutions to maintain and transfer these records safely and securely. And we believe we can achieve transparency in the use and distribution of financial account records by consumers, who can control how to initiate, manage, and terminate access to their information. We recognize there are real tensions around many of the issues discussed today, but we believe there's a promising path forward. Our goal is to put consumers first and to help providers find practical ways to improve their lives. Let us work together to do that. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite the panelists to please take the stage. While they're doing so, I'll briefly introduce both CFPB and guest panelists. David Silverman serves as the Bureau's Acting Deputy Director and Associate Director of the Bureau's Research, Markets, and Regulations Division. Holly Petraeus serves as the Assistant Director for the Bureau's Office of Service Member Affairs. Keo Chia serves as the Acting Assistant Director for the Bureau's Office of Community Affairs. Our guest panelists are Ed Merzwinski, U.S. Public Interest Research Group, Joe Valenti, Center for American Progress, Ryan Falvey, Center for Financial Services Innovation, Rob Morgan, American Bankers Association, Elena Gimberg, The Clearinghouse, and Stephen Bombs, InvestNet Yodlee. David, you have the floor.
Thank you, Zixta. And good morning, everyone. As Zixta indicated, I'm David Silverman. I'm the Acting Deputy Director of the CFPB, note the acronym ADD, and also the Associate Director of the Bureau's Research, Markets, and Regulations Division. It's a pleasure to be here today to moderate this panel discussion focused around consumers' ability to access and use their digital financial records. As Zixta indicated, we're going to hear from a number of respected panelists today. They include both consumer advocates and industry participants and members of think tanks. Each panel will give us some background and provide their perspective. We'll then pose questions to our panelists and engage in a discussion. The panel discussion will be followed by the public comments component of the hearing, where we'll hear from members of the public. As Director Cordray noted in his remarks, Section 1033 of the Dodd-Frank Act provides that consumers have the right to access their own financial information maintained by a financial provider about the consumer's use of their products. In the past 10 months, the Bureau began to meet with consumer advocates, our sister regulators, and market participants, including incumbent financial institutions, fintech firms, and data aggregators, to understand the benefits and risks of facilitating such access, as well as various access methods and technological standards. Both in Director Cordray's keynote speech at the Money 2020 conference last month, and in our first ever Project Catalyst report, we've expressed concern, which the Director reiterated this morning, about reports that some financial institutions are looking for ways to limit or even shut off access to financial records, rather than exploring ways to make sure that such access, once granted, is safe and secure. Today, the Bureau has published a request for information, or RFI, to seek information about current market practices related to access to consumer financial records. And we're here now to learn more about consumers' access to their digital financial records. This RFI and this field hearing are the next steps in a process the Bureau will undertake to engage with relevant stakeholders and evaluate any potential policy options to ensure consumer benefits are realized and harms addressed. So with that in mind, I'm going to invite our panelists to present their opening remarks. I'll ask each panelist to take about 3 minutes to make a brief statement, after which Holly, Kao, and I will moderate a discussion with the panelists. So why don't we start, Ed, if I can start with you on my far right. Introduce yourself and proceed.
Thank you, David. I'm Ed Mierzwinski. I'm with the Public Interest Research Group. US PIRG is a consumer advocacy coalition federation based in Washington with offices around the country. And I also serve on the board of Americans for Financial Reform, which is the coalition that fought to help build and develop the CFPB as part of Wall Street reform, and is now fighting to protect it, along with Senator Warren, who is the instigator of it. So I appreciate the opportunity to come out here to Utah to talk about this, and I want to build on the director's remarks, because I was trying to think of how to frame this, and the director said, we're looking toward the future. We're an agency that is looking to solve problems or develop policies that work for everybody, and I strongly believe that. And then I think back to, how did we end up with a CFPB? Well, back in the 1990s and the 2000s, the regulators weren't like the CFPB. They were worse than asleep at the switch, asleep at the wheel. They stood idly by while banks developed risky programs. Overdraft became a tremendous fee profit margin center for banks. Payday lenders ran amok. To be fair, the banking regulators didn't have authority over payday lenders exactly, but nobody did. And then the bank regulators ignored just real abuses in the credit card market. But then the biggie hit. The bank regulators, because they were largely captured by the banks, let the mortgage crisis occur, which led to the financial collapse of 2008, which led to the Great Recession, which many communities and states are still building out of. Millions of people lost their homes. Millions of people lost their jobs. Millions more people lost trillions of dollars in retirement income. And those regulators, I blame for a lot of the problem. They looked the other way. They didn't think about the future. Now we've got an agency that does think about the future, and it's looking at ways to guarantee consumer choice, to guarantee consumer privacy, and also to promote innovation in the financial marketplace. It's going to work with the banks, maybe push them a little bit to be willing participants in this area, but it's also going to encourage the new startups. And so I'm very encouraged about the opportunity to file in the request for information, to file a more detailed comment, but I strongly agree with all of the points that the director made about how we need to look forward and deal with these issues rather than simply standing aside and letting the marketplace not have adequate regulations. So we believe in my organization and in Americans for Financial Reform, the idea of the CFPB needs no defense, only more defenders. And we believe that going forward, this is an example of why we need a strong CFPB.
Thank you. Joe Valenti, Center for American Progress.
Good morning. My name is Joe Valenti, and I'm the Director of Consumer Finance at the Center for American Progress in Washington, D.C. I'd like to thank Director Cordray and the Consumer Financial Protection Bureau for inviting me to speak here today about consumers' access to their own financial records. Consumer data is immensely valuable to companies that collect and analyze behavior to optimize product marketing. Consumers may benefit indirectly from these efforts if technology more efficiently matches them with what they need, or they may be harmed if, for example, the resulting practices discriminate by race or gender. But consumers should not just see the indirect benefits from these valuable data. They should benefit directly in ways that improve their own financial health. Indeed, the CFPB's own definition of financial well-being includes having control over day-to-day, month-to-month finances. And here are 3 examples that illustrate how control over consumer data is consistent with this definition. First, consumer control may lead to better personal financial management. Firms have made it possible for individuals to consolidate their accounts on a single platform to track income and expenses, automate transfers and savings, and identify opportunities to manage their money better. In particular, making savings automatic is crucial to improve savings behavior. But without standardized data formats across a multitude of platforms, it may be difficult for these tools to succeed. Second, consumer control may improve product choices. As I noted in a recent article co-authored with University of Michigan law professor Michael Barr, consumers' reliance on direct deposit and electronic bill payment has many advantages. But consumers rarely switch their accounts from one financial institution to another because they would need to reestablish all of these automated account linkages. As a result, they may keep an account open at one financial institution, even if they could be better served elsewhere, and are far less empowered to vote with their feet should they find a particular bank's practices problematic. And that brings me to my third point. Consumer control leads to stronger accountability, as evidenced by what we've seen in credit reporting. Since opening its doors in 2011, the CFPB has called on credit card companies to make free customer credit scores public on monthly account statements. Some companies now even offer scores to non-customers. Making reports and scores widely available has helped consumers identify and resolve errors, particularly when combined with the CFPB's robust consumer complaint system. In just 4 years, the CFPB has received over 168,000 credit reporting complaints, many of which might have never been found or addressed without customer access to their own data. Before I close, I do want to mention there are clearly concerns to be resolved around data security and liability and a need to improve standards. But these are solvable concerns that should not interfere with the principle of expanded access to one's own financial information. Thank you. I look forward to your questions.
Thanks. Ryan Falvey from the Center for Financial Services Innovation.
Thank you, David. It's an honor to be here. CFSI is the nation's authority on consumer financial health. We lead a network of more than 120 financial services institutions from the country's largest banks, nonprofits, fintech providers, and nonprofits. In addition, through an innovative partnership with JPMorgan Chase, we also run the Financial Solutions Lab, the country's leading fintech accelerator program for consumer financial products. Since the lab's creation in 2014, nearly 600 organizations, for-profit and not-for-profit, have applied to be part of the program. We've invested in and worked closely with 18 of those organizations. These firms include organizations like Digit and Earn that help people save, products like Prism and Albert that help consumers plan, and even in Wise Banking help consumers access more affordable credit and build long-term resilience. All of these products depend on the ability to access consumer data for a variety of uses. These two factors give CFSI a unique vantage point from which to understand this issue. First, we know that in order for consumers to fully understand and ultimately improve their financial health, they need a 360-degree view of their finances. Many of the most exciting new products we're seeing in the market use data from many different sources to help people keep tabs on their finances, pay off their loans, manage their bills, and save on insurance costs. And it's not just the fintech startups. Many regulated financial institutions in our network are also developing new tools to help the consumers better manage their financial health, which depends on being able to access data from accounts at other institutions. Second, we hear from many of the same financial institution members that they have serious and legitimate security, reputational, and operational concerns about how data is accessed, shared, and stored by third parties. Given the complexity of this issue, CFSI spent the last year drawing on its network and researching expertise to understand the opportunities and challenges of consumer financial data sharing. Through that work, CFSI identified 5 aspirational principles that should guide the development and operation of the financial services industry, and you can download that at our website. These are the following. 1, data should be available. Consumers should have the ability to view their financial information with a trusted and secure financial application of their choice. 2, it should be reliable. That means it's timely, consistent, accurate, and complete. Access should be user permissioned. Consumers should provide explicit consent for access to and use of their data by third parties. Consumers should be able to easily view, modify, and revoke that consent. 4, it should be secure. All entities should follow applicable laws and industry best practices with regard to data privacy and security. And it should be limited to the application functionality approved, and only the minimum amount of data allowed should be kept. It's clear to us that aligning on shared principles is only the first step. We believe that there is a critical need for industry collaboration to ensure that consumers have secure and reliable access to their financial data and support continued innovation. Ultimately, what we want to see is a data sharing ecosystem that provides security and control for all consumers, is inclusive of small institutions, and generates trust among all market participants. Thank you.
Thank you. We'll move to my left, Rob Morgan from American Bankers Association.
Great. Thank you for having me. It's great to be back in my hometown. So I'm Rob Morgan with the ABA. And the ABA represents the nation's diverse banking system. And thank you for the opportunity to chat about this very important issue. Technology is rapidly changing how customers engage in banking and manage their financial services. Banks are innovating and partnering with startups to help make these innovative technologies available to their customers. But while banks implement some of these technologies, we need to move very deliberately to manage the risks associated with these technologies and make sure that consumers remain protected. In recent years, a number of companies have emerged offering data aggregation services. These services help facilitate bank fintech partnerships and give customers access to the innovative products that they love. They also do introduce new risks into the system that need to be carefully managed. So let me be clear. Banks fully support and are working to ensure that customers have the ability to safely share and control their data. This process is not as easy as flipping a switch, like some have suggested. There are a lot of parties that need to work together here. The nation's over 6,000 banks, their technology providers, the data aggregators, and their end users all need to come together to figure out how to make this work. Beyond these technical challenges, there are a couple of key issues that need to be addressed. Key among these is how we ensure that customers have security, transparency, and control when it comes to their data. So the first issue is security. Customers deserve bank-level security regardless of where they choose to share their data. Thanks. According to Accenture, 86% of customers choose banks first to manage and keep secure their data. This compares to just 2% who choose consumer technology companies to do this. There's a reason for this. Banks have strict rules and strong oversight that ensures that this data is as secure as possible. Common practices today that require users to give up their username and password introduce a lot of new risks to those customers that they may not realize they're taking on. Additionally, they may also be forfeiting some of their consumer protections, as many data aggregators limit the liability in user agreements and require their customers to grant them power of attorney. The second key issue is transparency. Customers have the right to know where their data is being shared and how it's being used. In particular, it should be clear to customers what data is being accessed, how long that data is being held, and how it's being used. Next is the issue of control. Customers should have control over what data is shared and how that data is used. Today, when a consumer forfeits their login credentials, they give data aggregators access to their full account data for an unlimited time period. Instead, customers should have intuitive controls that allow them easily to control and see who's receiving their data, modify the access, and revoke that access. Clearly, there's a better way forward to empower customers to share this data than requiring them to give up their login credentials. The good news is, I think we're all on the same page and want to get to this same place where customers get innovative services in a safe, secure environment. In order to accomplish this, there's a lot of work that needs to be done and serious issues to address. Banks are working on developing the systems to make this possible, and ABA stands ready to help industry as we come together and solve these challenging issues. Thank you.
Elena Gimbert from the Clearinghouse.
Thank you, and good morning, everyone. The Clearinghouse appreciates the opportunity to participate in this panel today and discuss important issues related to third-party access to consumer financial information. As a payments company and as a banking association owned by the largest commercial banks in the country, we fully support third-party access as long as it's achieved in a manner that protects consumers from harm and further protects the safety and security of the financial system. Over the past several years, the financial services industry has seen the rapid development of companies providing consumers with online personal data aggregation services. By gathering and presenting data from unaffiliated financial institutions, often on a real-time basis, data aggregators are able to provide consumers with the ability to assess their financial resources on a relatively quick, current, and comprehensive basis. In addition, some data aggregator services go beyond the mere sort of collection and presentation of consumer information, but also include data verification and transaction processing, such as bill payment for the consumer. While the industry encourages development of innovative financial services for consumers and is committed to meeting their customers' needs for data aggregation, the design and delivery of these services must principally be guided by safety and soundness considerations, particularly as they relate to consumer protection. Data aggregators' core practice of using a consumer's confidential and protected login credentials, username and password, to gain access to a bank's highly secure environment and the consumer's highly sensitive financial information has raised justifiable concerns. Banks are particularly concerned with, first, the privacy and security of consumer financial information as it moves out of the bank's environment and into an environment that is less regulated and supervised. Secondly, the lack of clarity or scope regarding consumer disclosures and consents that are provided to or obtained by the data aggregators. And on this point, I think it's important to note that once a consumer has enabled a third party to go into their online banking account, that third party can technically do anything that the consumer herself could do when she's online. So make payments, sign up for new services, request a loan, things like that can all be enabled once the data aggregator is inside their account. Third, the potential for breaches of data aggregator systems and the related potential exposure of consumers' private financial information or unauthorized transfers from their accounts resulting from such breaches. And lastly, the extent of consumer liability that can result in the event of a loss is suffered. On this last point, we note that most data aggregators in their contractual terms significantly limit their own liability, which in turn significantly increases consumer liability, though consumers may not be aware of this. We think all these risks are best addressed through both operational and legal relationships between data aggregators and banks. Such operational and legal arrangements enable banks to meet their legal responsibilities to their customers and their safety and soundness responsibilities to the financial system. Thank you.
Thank you. Finally, Stephen Bones from Yodlee.
Saving the best for last, David. Thank you.
Indeed.
Well, thank you for the opportunity to testify today. I'm pleased to share the perspective of Envestnet Yodlee, a leading global account aggregation platform provider. Yodlee provides safe and secure consumer permissioned account aggregation and other online services on a business-to-business basis to about 60 million registered consumers around the world. The Yodlee Consumer Permission Data Platform enables innovative tools across a wide range of needs that empower consumers to improve their financial well-being safely and securely. These tools include simple budgeting programs, automated savings applications, expense tracking applications, solutions that optimize fixed incomes and help consumers avoid late payment fees, and wealth management services, among many, many, many others. Through our 17-year history, Yodlee has built deep relationships with both traditional financial institutions and financial technology companies. Yodlee counts more than 1,000 companies as our customers, including 12 of the top 20 U.S. financial institutions. Leading-edge security tools and regulatory oversight are paramount in the data aggregation space. Accordingly, Yodlee is supervised and examined by the Office of the Comptroller of the Currency and has completed approximately 200 audits by our bank partners over the past 24 months. At Yodlee, we believe passionately in the democratization of data, the notion that consumers have an absolute right to access and permission their banking and other financial transaction information safely and securely in real time to reap the benefits of the innovative new tools that advances in technology have enabled. According to the Federal Reserve's 2016 survey on Americans' economic well-being, 1/3 of Americans are struggling financially, and 42% of Americans were unable to pay their bills at least 1 month within the last year. Nearly half of American households would have to incur debt or sell assets to pay for a surprise $400 expense. In our view, the only sustainable path toward improving Americans' financial lives is one that allows Americans to leverage intuitive, powerful technology functions that rely on access to their financial information via the tools and providers they choose to help them improve their financial health. Congress wisely recognized the importance of consumers retaining access to their financial data. Section 1033 of the Dodd-Frank Act presciently codified this right to assure that consumers are given the opportunity to take advantage of the broad range of technology-powered, data-driven tools that are available in the market to empower them to improve their financial health. With that said, today's field hearing is a timely one. Despite Section 1033 of the Dodd-Frank Act, Americans' access to their financial transaction data to power these impactful tools is under threat. Some U.S. financial institutions have instituted a range of technical and administrative hurdles that interfere with the consumer's rights of access to their own financial data. Financial institutions have moved to limit the amount of data that consumers can share, or are seeking to define bilateral agreements with onerous contractual terms that would restrict consumers' ability to take full advantage of marketplace solutions. As a result, there are an escalating number of cases where consumers are excluded from engaging with services provided by the financial technology community best suited to improve their financial well-being. To remedy this situation, we propose the creation of a Consumer Bill of Data Rights that codifies the consumer's absolute right to control access to their own financial data, and in turn, to utilize the power of technology to improve their financial well-being. We recognize that financial institutions operate in a highly complex regulatory environment with legal and moral obligations to protect their customers' assets. We therefore believe that the consumer's right to their financial data should be granted in a balanced, principled ecosystem that defines the responsibilities of all players in the markets: consumers, financial institutions, aggregators, and fintech providers. Above all, the consumer's best interest should be the collective goal of all of the players in this ecosystem. The democratization of data comes with requirements for all stakeholders in the 21st century's financial services system, all in support of enabling and protecting the American consumer and their financial data. The growth of financial technology sector brings with it immense opportunities to empower Americans to take better control of their finances and in turn to offer their children the essence of the American dream, a life better than their own. Thank you once again for the opportunity to testify today.
Thank you, and let me thank all the panelists for their thoughtful opening remarks. So Holly, Kale, and I will now engage the panelists in some questions and answers to try and engender some interesting dialogue. And let me start with you and ask whether, in your experience, consumers understand the risks and benefits of using the tools that aggregate their financial records.
I don't think consumers, except for the percentage who are already in the game, I don't think consumers really know enough about it. Absolutely, there are some risks of data security or the company possibly using information for some other purpose, but I think those are all risks that can be fixed, and I think they are all risks that can be fixed by government standards. As for the benefits, no, more people would be out there doing this and participating in this marketplace and taking advantage of the new choices that they had if they knew about it. But I don't think consumers understand either the risks or the benefits. That's why this hearing is very important. That's why your request for information is very important as well.
Thanks. Holly?
I have a question for Steve Bombs. What types of products and services are currently made available to consumers that rely, at least in part, on consumer permissioned electronic access to consumer financial records? And how does that benefit consumers?
Thanks for the question. It's a great one. In our view, the benefits of the innovations in technology are that they meet consumers where they are at every stage of their life cycle. So there are, for example, products and services in the personal financial management space that empower consumers to establish budgets, to monitor their spending, and to establish good financial habits. As I mentioned in my opening remarks, there are tools that enable consumers to optimize fixed incomes. There are tools that help consumers avoid fees charged by their financial institutions, like overdraft fees or late fees. Consumer data enables automated savings platforms that help consumers boost their savings beyond what they would normally put away. With consumer permission data, investment platforms can optimize investment strategies for consumers to help them live comfortably in retirement. Data-powered solutions can also help with account verification and fraud reduction, which is also helpful to financial institutions, as well as compliance in areas including responsible lending and investment advice. And those are just the solutions that we know right now. Who knows 5, 10 years from now what new innovations will come in this market?
Kale?
This question is for Joe Valenti with the Center for American Progress. Why do consumers need access to their financial records through third parties? And how should this be balanced with the desire for security and privacy?
Great. So first of all, I do want to point out that the liability issues here are real, and they're issues that we see across the space of mobile apps and technology in general. But this is really a case where the genie is out of the bottle, even though many people may not understand or appreciate some of the risks that are involved. It's great for financial institutions to offer opportunities to use their financial data better on a first-party basis, but that's going to be uneven across institutions, and relying on third-party providers offers several benefits. One is to unlock opportunities that a particular financial institution may not offer. Another is to deal with the challenge of unbundling, that we're in an environment where an individual probably does not have a checking account, a savings account, a retirement account, a mortgage, and a credit card, all with the same financial institution. All of these different products are increasingly spread out among multiple players. And we see evolution in this space. We see prepaid accounts that look like bank accounts, as an example. Ultimately, the goal of expanding access to one's own records needs to be where we focus our energy. Data that's kept in secret may be erroneous, inaccurate, or non-verifiable, as we've seen with credit reporting. I would argue that we do need to have better protocols and standards for data security. We need to have the ability to modify or revoke consumer consent, or to control whether an entity is able to view your records versus being able to change or move around money that is in your account. We also need to pay attention to equal protection issues and the risk of discrimination or improper practices by some of these actors. But on balance, consumers are better off if they can access their records through third parties conveniently and safely.
Alana, what incentives or disincentives exist for financial institutions to facilitate or discourage consumer permissioned access to their financial records?
Sure. So I think fundamentally banks want their customers to be happy. That's how their customers stay their customers. And so their incentive for allowing access is to keep with sort of evolutions in the marketplace and to stay competitive. So there's intense competitive pressure for banks to make data aggregation work. That said, banks are subject to extensive safety and soundness requirements as well as consumer protections. And so I won't describe that as a disincentive, but it is the reality in which banks operate. And so anything that they do to enable services by data aggregators has to be done in a way where the bank feels comfortable that there's not going to be harm to consumers and that they can still meet their regulatory requirements and their own internal sort of risk levels.
Holly?
This one's for Ryan Falvey. In what ways should financial institutions consider consumer concerns and interests regarding access to their financial account data, and are there any gaps that need to be addressed?
Thanks, Holly. Excuse me. So our principles were designed for consumer financial institutions to be able to put consumers at the center of this discussion and their interactions in this issue. So for each of the principles we identified, we outlined specific practices that we think entities in this value chain can execute to bring consumer interest to the fore. So for example, in availability, we really think collaboration between financial institutions and third parties is critical to allow that to happen. Those entities should work together to vet those entities that are touching the data and develop standards for how that should work. And reliability, entities should coordinate to figure out data definitions and to develop when data is pulled, the requirements to enable that kind of connectivity, and also provide a clear error resolution channel for consumers. On consent, it's quite straightforward. Consumers should consent to access to provide their data, and they should have mechanisms to turn that off. Security, this is one area I think that was challenging for us as we work through these principles. There's a lot to dig into there, but certainly whatever we go down needs to take the best practices in security and instill that as part of the process. And finally, on minimization, we really would want to push the industry to avoid bringing excess data and taking risks of holding data that's not necessary for long periods of time. So that means just defining the minimum data needed for an application functionality, and then defining how long that should be stored to allow that application to work. That said, our principles were out without significant gaps. One of those is it is not at all clear how we can fully and securely include small financial institutions into the data sharing ecosystem. Many of the technology solutions currently available might be challenging for resource-constrained smaller institutions. We do not believe that technology standards should be a barrier to competition, so an industry-wide solution is needed to enable consumers to choose small institutions and allow those small institutions to compete for providing better products for consumers. Legacy system infrastructure generally is probably need to be upgraded to enable this to occur. That probably means inviting partners to the table who we might not normally think about. So those are providing core banking systems, modular software, and helping to figure out how we can develop some standards that can really apply across a whole swath of financial institutions. And finally, I think the industry might struggle to develop functional and flexible technical implementation details amidst some of the competing business interests without encouragement and guidance from policymakers. The principles we created were guidelines. Many of them, the practices support these goals cannot be implemented without more detailed standards. And this will require time, resources, and buy-in from across industry. While that private sector coordination is occurring, we do think the process could be encouraged and supported with positive government and policymaker engagement here.
Kale?
This question is for Rob Morgan. What are some of the challenges that smaller financial institutions like community banks face in securely sharing their customers' financial records?
This is a great question, thanks. And community banks face a really unique set of challenges in trying to facilitate this safe sharing of consumer data. And I think the first challenge is really in their scale. Most community banks are simply not big enough to be on the radar of a lot of the data aggregators. I was having a conversation with a bank the other day who's the second largest bank by market share in the Denver area, and they've never been approached by any of these aggregators. So they're left with two options. When the requests come in from some of the aggregators, they can see that these are automated requests. They can either shut those off and do wrong by their customers, or they can open them up wholesale without being able to have conversations about how to put the proper protections in place to make sure that they're comfortable with what's happening with their consumers' data. So the second key issue is a technology one. And community banks are heavily reliant on their core technology providers. Without the support of these technology providers, they're not able to roll out new innovative products to their customers. So I think the core providers play a really key role here in helping enable the community banks to build this more secure way to share customer data.
Great. Thanks. So let me ask a final question for all the panelists. And that's the question is, in the absence of regulatory action, do you believe industry, other stakeholders will develop standard practices to allow sufficient access to consumer records by permission parties while balancing the concerns of financial account data holders? And why don't we go in the same order in which we open? So Ed, start with you and come down the line.
Thank you for the question, David. And I was born at night, but it wasn't last night. In my almost 30 years as a consumer advocate, I can tell you that the offer of creating voluntary standards is one that industry makes all the time to delay regulation or to delay legislation and to delay customer protections. So I don't think this will work unless we have enforceable minimal standards by a federal agency. And I strongly recommend that no rules work unless their basic underpinning is enforceable by either a federal or a state regulator. It's got to happen, otherwise consumers lose. And this is another reason we need a strong CFPB, because the CFPB can be the agency that is visionary enough to look at this issue and look at the benefits to all parties, but also to protect consumers.
Joe?
Thank you, David. I would agree that the answer is no, that this is an area where individual consumer access must be ensured through regulation, because I don't see it as something that is likely to happen voluntarily. It's really a collective action issue at its heart. And I'd go back to what I had mentioned earlier about access to your individual bank account records and how challenging it is to switch from one bank to another. That you would need to reestablish all of these linkages from scratch, and bank accounts, unfortunately, are not portable the way that cell phone numbers are, or the way that, for example, postal mail forwards. This is a case where I can't imagine any institution wanting to be the one who goes first, but ultimately all would benefit in a more competitive marketplace where people could, for example, move their money not only from one large financial institution to another, but to smaller community banks and credit unions if that's what they would choose and that's what best serves their needs. I also see the need for regulation as being a matter of trust. A recent Gallup poll had reported that only about 1 in 4 Americans have either a great deal of confidence or quite a lot of confidence in banks, and having standards across the board that are enforceable by an agency like the CFPB, I think could go a long way to building that public trust in the financial sector.
Right?
So I think we think this is an area that is kind of ripe for a principles-based approach. The emergence of these new intermediaries and aggregate financial data from sources have really helped traditional financial institutions to better understand their own consumers and contributed to a rapid growth of third-party innovation. They've empowered consumers to see, to manage their financial lives in new ways and really entirely new product categories that didn't exist a year ago, 2-3 years ago. So in short, it's a rapidly changing space. We're seeing innovation from large regulated financial institutions developing API banking platforms, new dashboards to allow consumers to give them greater control over how they control their data. We're seeing really interesting new products launched, not just by fintech providers, but we work with a nonprofit in San Francisco called Earn, which helps do match savings for very low-income Americans. They are using aggregator technology to expand their service outside of their traditional area in the Bay Area to entirely new markets and grow at a rate that just exponential compared to what they were doing before. So given that dramatically changing environment, and also I think our sense that the vast majority of the actors, at least that we're engaging with, seem to have the consumer's best interest in heart, what we hear from our stakeholders is a desire for guidance on top-line issues, but space to adapt to market demands. As such, at this stage, we would encourage the CFPB to consider providing industry guidance via principles versus prescriptive rules. Arguably, Director Cordray's comments last month and today certainly help providers to understand how the market's evolving. But for regulated financial institutions, questions of liability, cost, and security remain at the fore. For aggregators, there is concerns about connectivity, data quality, and the ancillary uses of data. For fintech providers, there are serious questions about the quality of the data they're receiving, the cost, and the consumer experience of accessing that data. To us, the most important stakeholder part of this conversation is the end consumer who stands to gain through new innovation, new products, and greater competition. And it is this voice that needs to be part of the conversation, and it is this voice that the CFPB can bring to the table. That is a critical player in this industry and in this dialogue, and I think that guidance from the CFPB on how we can drive forward on some of the trickier implementation issues would be really valuable. So we'd encourage the CFPB to continue to study this issue, engage with industry, and at least in the near term, take potentially a less prescriptive approach to setting rules and rather focus on the principles toward what they want the private sector to strive. Ultimately, we're optimistic about the industry's ability to come together around shared standards and best practices and are looking forward to playing that role in the coming months.
Thanks. So in short, I think yes. I think industry has already started to come together to push some of these standards forward. And I think today's conversation, you can see that conversation's really begun already. At the end of the day, everyone here wants the same thing. We want a more secure portal to help push that access that gives the consumer control. There are a lot of banks working today on platforms that can enable this. Joe, I know you said no one wants to go first, but there are a lot of banks that have gone and pushed out open platforms that are enabling this more secure way to share data. So I think these parties are coming together. And as we push this forward, I appreciate the remarks earlier to the effect of looking out to the future. I think we need to look 10 years down the road where the type of data and the technology for sharing it is going to be very different. So we need industry to collaborate here, to come up with a set of standards that's flexible enough to allow for that type of innovation, not a strict set of standards that could actually limit innovation going forward. This being said, I do think the CFPB has a strong role to play here. First, in terms of education, making sure that customers are fully aware of their risks and the benefits when they choose to share this data and how they do it. And I think hosting conversations like today are a really important aspect of this as well. Getting industry together and facilitating these types of conversations, whether it's through hearings like this, or through Project Innovate, or some of the efforts that even the OCC has taken to help support innovation, are all really important venues to have these conversations.
Yeah, I agree. So I believe it is possible to kind of get where we want to go without prescriptive regulation. And I would point to the work that's happening today in the faster payments space. I mean, the industry sort of, with the good facilitation of the Federal Reserve, has moved forward, and we are moving payments faster, or going to be moving payments faster very soon. And that's totally been done without regulation. So I think our expectation at the clearinghouse, because as I listen to us all today, I don't hear us being that far apart, frankly, in what we're concerned about and where we want to go. So I think that we can, I think we're pretty close to aligned. I think we can probably get enough aligned in our interests that we can sort of work on our own. I think the CFSI principles are a great start. So I think we can do this without regulation. And that we can find sort of practical ways. I think when industry works on things together, I think we come up with things that are practical and commercially viable, and things that will sort of hold true 10 years down the road.
And now, the best for last again. Steve.
Thanks. So I think we probably have a bit of a unique perspective. We've been in this market for 17 years. We've built good relationships and strong relationships with fintech players on the one hand and financial institutions on the other hand. And we've done that in the absence of regulatory action throughout the almost last 2 decades now. I would largely agree with what you've heard, which is that we think that all the players in this ecosystem have a role to play, as I said. So consumers, financial institutions, aggregators, fintech companies. The key difference in our perspective, though, is we don't think that you can establish those responsibilities until the consumer's absolute right to access and permission their data has been asserted and aggressively protected by a government entity like the CFPB. So therefore, we would say that we think the industry is more than capable of determining the responsibilities for safe and secure data access and permission sharing, in addition to good governance that balances innovation with safeguards, disruption with competition, and protection with empowerment. But to get there and to foster that conversation, our recommendation with the CFPB, in addition to some other regulators, should assure the consumer's right to their data to help them improve their financial health.
Thank you. So this concludes the panel portion of our program. Let me ask you to join me in thanking all the panelists for a thoughtful discussion. Now let me invite the panelists to return to their seats and turn the program back over to Zixta Martinez, our Associate Director for External Affairs, who will moderate the next portion of the field hearing.
Thank you, David. And let's give another round of applause to our panelists today. An important part of how the Bureau helps consumer finance markets work is to hear directly from consumers, from community banks, from credit unions, from members of the industry, from our state and local partners, and from community advocates across the U.S. One of the ways that the Bureau gathers public feedback is through events such as these. We have held field hearings, town halls, and other gatherings across the U.S. from Miami, Florida, to Itta, Mississippi, to Seattle, Washington. At these events, we not only hear from experts in the field, we also invite the public to participate. Before I open the floor up for public comments, I want to remind folks that there are several other ways to communicate your observations, your concerns, or your complaints to the CFPB. You can submit a consumer complaint with the CFPB through our website at consumerfinance.gov. Our website will walk you through that process. Or you can call 1-855-411-2372. The CFPB takes complaints about mortgages, car loans and leases, payday loans, student loans, or other consumer loans. We take complaints about credit cards, prepaid cards, credit reporting, debt collections, money transfers, bank accounts and services, and other financial services. If you don't have a specific complaint but would like to share your story with us, we have a feature on our website called Tell Your Story, where you can tell us your story, good or bad, about your experience with a consumer financial product or service. Your story will help inform the work that we do to protect consumers and create a fair marketplace. We have another feature called Ask CFPB, where you can find answers to over 1,000 frequently asked questions about consumer financial issues, as well as additional resources. We have a Spanish language website called CFPB en Español, which provides access to essential consumer resources as well as answers to frequently asked questions. I encourage you to visit consumerfinance.gov to learn more about the resources and tools that the Bureau has developed to help consumers make the best decisions for themselves and for their family. Now it's time to hear from members of the public that are here today. A number of you have signed up to share comments and observations about today's discussion. The public comment portion of the field hearing is also an important opportunity for the CFPB to hear about what's happening in consumer finance markets in your community. Each person who signed up to provide public testimony will have about 2 minutes to do so, and we're eager to hear from all of you. Our first commenter is Nick Thomas. Mr. Thomas, we're bringing a mic to you.
Thank you very much. My name is Nick Thomas. I'm co-founder of Finicity, a leading financial aggregator, and co-founder of Envelopes, a leading consumer budgeting app and financial literacy platform. We've been helping consumers improve their financial lives for the last 17 years, and are leading standards initiatives like OFX to standardize the industry, as have been talked about today. My question is regarding the definition of usable data as mentioned in Section 1033. Today, the time lapse between a financial account event and transaction data availability via data aggregation can take several days. Section 1033 states that data should be made available in a usable electronic form. Do you see real-time data delivery an important aspect of data usability?
Thank you for the comments. We're not answering questions at this point, but really appreciate that you've identified something for us to really think about and digest. Ryan Christensen. Okay. Thank you, Mr. Christensen. Adam Thorpe. Adam Thorpe. Janetta Williams.
I want to thank you first for being here and allowing us to make comments this afternoon. My comments would be on the payday lenders, and presently there are roughly about 36 states currently allow storefront payday loans, and of those, all but 7 put some cap on how much interest the lenders can charge. Utah is one of the non-cap states, and because of that, lenders here charge an average of 482% annual interest on those. There have been loans made in Utah with annual rates as high as 1,564%. In states with the most restrictive regulations, the average rates are around 250%, according to a study by the Pew Charitable Trust. The study also shows that in permissive states like Utah, more people tend to take out payday loans than in states where rate and fee caps are in place. All of this speaks to the need for our legislature to consider the kinds of regulation embraced by our neighboring states, Colorado and Wyoming, which have lower than average rate caps. But it also speaks to the lobbying clout of the payday loan industry, which has been known to shower key politicians with healthy campaign contributions. And there is a very strong need for the CFPB to stay in place, and we appreciate the work that's being done, and we appreciate Director Cordray for his comments today, and also I've met him before and talked with him, and I appreciate the work that he's done with the NAACP and our Director, Hillary Shelton.
Thank you, Ms. Williams. Thank you to all that provided thoughtful testimony today. Thank you to the audience, to the panelists, and to all those watching via live stream at consumerfinance.gov. This concludes the CFPB's field hearing in Salt Lake City, Utah. Have a terrific afternoon. Thank you.